Agile FX trading with purpose, growing in abundance. Hello traders, welcome back to another lesson in our forex series. In the last video, we talked about who participates in the market. Today, let's explore what exactly is traded in the forex market, the different types of currency pairs, and what really drives these currencies up or down. Upon finishing this lesson, you should know the answers to the following questions. What are the currency pairs? What are the most common currency pairs? What are the major pairs? What are minor or cross pairs? What is meant by exotic pairs? What pairs should I focus on? What is traded in the forex market? In forex, we don't trade physical good. We trade currency. Currencies are always traded in pairs, meaning one is bought while the other is sold. For example, if you trade Euro USD, you are buying the euro and selling the US dollar at the same time. Most heavily traded currencies, the US dollar USD is the most dominant, used in over 80% of global trade. Other major currencies include euros, the second most traded, Japanese yen JPY, British pound GBP, Swiss franc CHF, Canadian dollar CAD, and Australian dollar AUD. These currencies are very liquid, meaning they can be traded in high volume with low transaction cost. Then you have factors that affect an economy and currency. Currencies move because of fundamental changes in economies. Some key factors are politics, elections, government stability, or new policies can strengthen or weaken a currency. We have interest rates. Higher rates attract investors and usually strengthen a currency. Then natural disasters, earthquakes, floods, or pandemics can weaken a country's economy and its currency. Terrorism and wars. Conflict reduces investor confidence, making currencies fall. Unemployment. High unemployment is bad for an economy, lowering currency value. Export and import. If a country exports more than it imports, its currency usually strengthens. Let's look at major forex pairs. These are the most traded and most liquid currency pairs in the world. Example, we have Euro USD, Euro versus US dollar, most traded in the world. USD JPY, US dollar versus Japanese yen. GBP USD, British pound versus US dollars. USD CHF, US dollar versus Swiss francs. Then we have what they call cross pairs. These are pairs that do not include the US dollar. Example, we have the Euro JPY, that is euros versus Japanese yen. Then we have the GBP JPY, that is British pound versus Japanese yen. We have the Euro versus British pound. And lastly, you have the exotic currency pairs. These pairs involve one major currency and one currency from a smaller or developing country. For example, we have the US dollar versus Turkish lira. We have the US dollar versus South African rands. These are less liquid, more volatile, and have higher spreads. Now we go to what pairs traders usually ask themselves. What pairs, especially the beginners, what pairs to trade? Beginners should focus on major pairs like Euro USD, GBP USD, or USD JPY because they are liquid, predictable, and have lower costs. Cross pairs and exotic pairs can be traded later, but they require more experience because they are riskier. So, in forex, we mainly trade currency in pairs: majors, crosses, and exotics. The value of this currency changes daily depending on political events, interest rates, wars, and economic performance. If you are just starting out, stick with major pairs. In our next lesson, we will dive deeper into how to analyze these pairs and spot trading opportunities. Don't forget to like, subscribe, and hit the bell so you don't miss the next video. Narrated by David Oyero, trainer of Agile FX Academy.